Stocks play a pivotal role in financial markets, offering individuals the opportunity to own a portion of a company and potentially grow their wealth. This chapter provides an essential overview of stock ownership, explaining how buying shares makes you a part owner of a company and the rights that come with it. We will also explore the different types of stocks, such as common and preferred shares, each with unique characteristics. Additionally, this chapter covers the practical aspects of trading stocks through brokers, including how to open a brokerage account, place orders, and manage your investments. By understanding these fundamental concepts, you'll be better equipped to make informed decisions in the stock market. Chapter 5. Understanding stocks. The basics of buying and selling shares. Stocks are a fundamental component of the financial markets, representing ownership in companies and offering investors a means to build wealth. For companies, issuing stock is a critical method of raising capital to fund growth, operations, or expansion. This chapter will dive into the core concepts of stock ownership, explore the various types of stocks available, and detail the process of buying and selling shares through brokers. Stocks is ownership in a company. When you buy a stock, you become a fractional owner of the company, granting you shareholder status. This ownership is foundational to modern capitalism and financial markets. Through stock ownership, investors gain potential financial returns and a direct stake in the company's success or failure. Equity ownership. Stock ownership represents a stake in the company's equity. As a shareholder, you are entitled to a portion of the company's assets and profits, though these benefits come with no involvement in daily operations. Shareholders benefit in two primary ways. 1. Capital appreciation. As the company grows and generates profits, its stock may increase in value. Investors can sell their shares at a higher price than they paid. 2. Dividends. Some companies distribute profits directly to shareholders through dividends, providing additional income. The rights of shareholders. As an investor, stock ownership entitles you to several rights that protect your interests within the company. Common shareholders typically enjoy 1. Voting rights. Shareholders can vote on major decisions affecting the company. 2. Right to dividends. Common shareholders receive dividends based on their share ownership. 3. Right to information. Shareholders can access financial performance reports for transparency. Types of stocks. Stocks are not a one-size-fits-all investment. Different types cater to various investment strategies and risk tolerances. Common stocks. Common stocks are the most prevalent form of equity traded on exchanges. Owning common stock typically provides shareholders with voting rights and potential for capital appreciation. Key features. 1. Voting rights. 1 vote per share. 2. Higher potential for capital gains, greater growth potential but also higher volatility. 3. Dividends, not guaranteed but may be paid if profits allow. 5.2.2 Preferred stocks. Preferred stocks operate differently from common stocks. They generally do not offer voting rights, but provide fixed dividends. Key features. No voting rights. Preferred shareholders cannot vote on company matters. Fixed dividend payments. More stable income for investors. Priority over common shareholders. In liquidation events, preferred shareholders are paid before common shareholders. 5.3 Risk and return. Investing in stocks involves balancing risk and return. Stocks can provide substantial gains, but also fluctuate due to various factors. 5.3.1 Volatility and fluctuations. Stock prices are inherently volatile, influenced by market trends. Economic cycles and interest rate changes can drive price swings. Company-specific factors. Earnings reports or leadership changes can significantly impact stock value. Global events. Geopolitical tensions or natural disasters often lead to market-wide volatility. 5.3.2 Risk tolerance. Understanding your risk tolerance is crucial in stock investing. 1. High risk, high reward investments. Growth stocks may offer significant capital gains but come with higher volatility. 2. Low risk, stable income investments. Dividend stocks from established companies may provide consistent returns with lower price swings. 5.4 Fundamental analysis and valuation. To make informed investment decisions, it's essential to evaluate a company's financial health through fundamental analysis. Key ratios include 1. Price to earnings, PE, ratio. A measure of a company's current share price relative to its earnings per share, EPS. A high PE may indicate overvaluation, while a low PE might suggest undervaluation. 2. Return on equity, ROE. Indicates how effectively management is using a company's assets to create profits. A higher ROE suggests efficient management. 5.5 Investment strategies. Different investment strategies can help achieve various financial goals. 1. Value investing. Seeking undervalued stocks that have strong fundamentals but are trading below their intrinsic value. Growth investing. Focusing on companies expected to grow at an above average rate compared to their industry or the overall market. Index fund investing. Investing in index funds that track specific market indices, providing broad market exposure with lower fees. 5.6 Market mechanics. Understanding how stock exchanges operate is crucial for investors. Stock exchanges. Platforms where buyers and sellers meet to trade shares. Examples include NYSE and NASDAQ. Market makers. Firms that provide liquidity by being ready to buy or sell stocks at any time, ensuring smoother transactions. Diversification. Diversification is vital for managing risk in an investment portfolio. Building a diversified portfolio across different sectors reduces exposure to any single investment's poor performance. Including various asset classes, stocks, bonds, real estate, further mitigates risk while potentially enhancing returns over time. Real-world examples and case studies. Analyzing successful investors like Warren Buffett provides insights into effective investment strategies. Buffett's focus on value investing has been a cornerstone of his success. Examining different stock types during varying economic conditions reveals valuable lessons. During the dot-com bubble burst in the late 1990s and early 2000s, technology stocks experienced a dramatic decline, while more stable sectors like utilities weathered the storm better. The COVID-19 pandemic saw technology companies providing online services thrive, as consumer behavior shifted dramatically. The Russia-Ukraine War, 2022 present. This conflict has had a profound impact on global markets, leading to increased volatility and uncertainty. For example, energy prices, particularly oil and gas, have surged due to sanctions on Russia, a major energy exporter. Global inflation and rising interest rates, 2021 present. The global economy is experiencing a period of high inflation, prompting central banks worldwide to raise interest rates to combat rising prices. This has led to a decline in stock markets, as investors become concerned about the impact of higher interest rates on corporate profits and economic growth. Supply chain disruptions, 2020 present. The COVID-19 pandemic exposed vulnerabilities in global supply chains, leading to shortages and delays in various industries. While the pandemic's immediate effects have subsided, supply chain disruptions persist in certain sectors. This example could be used to illustrate how company-specific factors, such as supply chain challenges, can affect stock performance. The rise of artificial intelligence, AI, 2022 present. Advancements in AI, particularly generative AI like ChatGPT, have captured significant investor attention. Companies involved in AI development and applications have seen their stock prices surge as investors anticipate the transformative potential of this technology. How to buy and sell shares through brokers. To buy or sell shares, you will need to use a broker who can access stock exchanges on your behalf. Opening a brokerage account. The first step is to open a brokerage account. Full-service brokers offer comprehensive advice but come with higher fees, ideal for those wanting professional guidance. Discount brokers provide limited services at lower fees, best for self-directed investors. Online brokers, popular for low fees and user-friendly platforms, great for fast execution of trades. 5.10.2 Placing orders. When ready to trade, place an order with your broker. Market orders. Execute immediately at current market prices. Not price guaranteed but ensures completion. Limit orders. Set specific buy/sell prices. Offers control but may not execute if price isn't reached. Executing trades and monitoring investments. Once an order is placed, the broker transmits it to the exchange. After execution, shares appear in your account. Regularly monitor investments using tools provided by your broker for performance tracking and market news alerts. 5.10.4 Selling shares. When selling shares, consider market conditions, timing based on market trends, rising or falling, investment goals, reasons for selling, profit taking or rebalancing, tax implications. Be aware of capital gains taxes that may apply upon sale. Conclusion. Understanding stock ownership fundamentals. Types of stocks available. Fundamental analysis techniques, investment strategies, market mechanics, diversification importance, real-world examples, and the buying/selling process through brokers is essential for any investor. Stocks offer opportunities for wealth creation alongside risks requiring careful consideration. By staying informed and aligning investments with financial goals, while being aware of market conditions, investors can navigate the complexities of the stock market confidently. This revised chapter aims to provide comprehensive insights into buying and selling shares, while engaging readers through detailed explanations and practical examples tailored to various levels of investment knowledge.